All right, this is going to be a short video on some various types of earnings trades and why rising IV doesn't necessarily let you put on a free straddle before earnings. So some of the reasons I like trading earnings is that it's limited market exposure, typically only in these trades for a few days. It's uncorrelated to my core positions, which is typically long the market or short butterflies and put options. Limited margin and buying power. A lot of these are debit trades that can be put on for fairly inexpensively. And there's some potential edge that we're playing with on both the pre-earnings trades, which take advantage of this rising IV environment, which is shown in the left-hand side of this chart, as well as the IV crush trades, which take advantage of IV coming out of our options, typically after the earnings event. I'll put a link in the description for this paper, but this looked at about 300 different tickers or companies before earnings. So earnings is T minus 0 shown here. So anything before earnings is on the left of this chart. Anything after earnings is on the right of this chart. So there's a lot of trades we can do both on the pre-earnings side as well as the post, or what I call hold through earnings side, that take advantage of IV crush. Today we're going to focus mostly on the pre-earnings side of things. So we saw that before earnings, so earnings is 0 here on the x-axis, we typically see rising IV environments on our stocks coming into the earnings event. Here's an example with JPM, which is JP Morgan. You can see the IV starts off at about 25 and gets all the way up to a median IV of around 125 right before the earnings event. So a new trader might see this and say, this is great. Look at this rising IV. I'm going to buy options before earnings, ride this rising IV, sell it right before the earnings event, and just make free money. Unfortunately, rising IV does not equal free money, and you cannot buy beer with IV. And I will talk to you a little bit about why that is the case. So again, we're still on JP Morgan. This is a back test showing straddle returns over the past 8 earnings cycles. And as you can see, the median straddle return is negative for most of these different positions. And so how this chart works is on the day before earnings, so the day that you enter it would be here on the y-axis, and the day you exit the trade would be here on the x-axis. So most of the time for straddles, we're going to exit right before earnings come out. So that would be this column, T minus 0. And it doesn't matter when you enter the trade, when you enter the straddle, you're going to lose money most of the time by buying straddles on JPM before earnings. This is shown visually with this chart here. Now we're looking at straddle prices. So this chart was just looking at IV. Now remember, IV is only one component of an options price. Here we're looking at the straddle price going into earnings, earnings being here on T minus 0, and the straddle prices are just going down and down and down and down every single day until earnings come out. And so why is that? We're going to use the banana stand analogy, and we're going to pretend for a minute that we are selling bundles of bananas. And every single day, we're trying to get more people to buy our bananas, so we're going to increase the number of bananas that we're selling. So on day 1, we're going to sell a certain number of bananas. On day 2, we're going to add some more bananas to that bundle. Day 3, we're going to add even more bananas to that bundle, and so on. So do you think our price of bananas should increase or decrease as we keep adding bananas to our bundle? Just like this, do we think the price of our options should keep increasing as we're adding IV to it? Let's see what happens. So on day 1, we're selling 5 bananas. Day 2, we're selling 6 bananas. All the way on to day 6, we're selling 10 bananas. But look, the price of our banana bundles is actually going down. And that's because we all know bananas, they decay, they get rotten. So a banana here on day 6 is not worth as much per banana as a banana on day 1. This is a nice fresh banana. It's worth a lot more than this banana. So even though we're increasing our bananas, because the value per banana is going down, that's why these bundles of bananas are decreasing. So let's turn this into options. We know that as time goes on, we actually lose money in our options. They become less valuable. So a buyer is going to pay less for an option that expires in 5 days than an option that expires in 25 days. Just like a buyer of a banana is going to pay less for a banana that's going to expire in a day than a banana that's going to expire in 10 days. So that's why the prices of these straddles, these options, decrease even though we saw for JPM that the IV was increasing. It's because as time goes on, the value gets less and less and less. And so that's why you can't buy beer or bananas or whatever you want with IV alone. The good news is that some stocks actually do hold their value pretty well. So maybe they coat their bananas with some special coating. Maybe there's just a lot more value to that type of banana. But there are lots of stocks that hold their value. And so this is from that same paper we referenced earlier, where we're looking at buying straddles 3 days before earnings and selling them right before the earnings come out. So we're not taking into account IV crush here. This is exiting trades before the earnings come out. This looks at those same 300 stocks over about a 7 or 8 year period. This goes up to I think 2012 or 2013. And it shows on most quarters, each of these lines here is a different quarter. If you just held a delta neutral straddle 3 days before earnings and sold it the day before earnings, they have a positive return. And these are delta neutral, so you're not even making money by stock movement. This is really just the power of that rising IV and straddle prices holding some of their value during that time period. So Nike is a really good example. Nike has a lot of big moves at earnings, and for that reason, the market makers have to keep those option prices elevated. Plus, you probably have a lot of institutional buyers coming in before earnings and hedging their positions by buying options. And so for that reason, this is the straddle price again, but instead of going straight kind of down at a 45-degree angle like JPM did, we can see that these straddle prices hold their value pretty well. It's not a completely risk-free trade. The line is decreasing a little bit, but it's a lot better than JPM. And because of this, you can see now in this chart, this is actually the median return. So this is like a back test showing Nike straddle returns entering all these different days before earnings and then selling right before earnings come out. So if I was to trade this, I would look for an entry maybe at T-11 to T-9. There's some good trades to be had within there if you can catch a slight little dip in the straddle price. Or the safer trade would be to put on a straddle around T-3, T-2. At T-3 at least, the median straddle price return would be 10% per trade. So if you can find a bunch of different tickers that have these sort of profiles and IV that holds its own, these can be really profitable, mostly risk-free type trades. So that's it for this video. I think in my next video we'll talk about some different earnings crush type trades, and please subscribe if you like it. Thank you.